Hi, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 7th, 2026. Hey, how you doing? How was your week? I appreciate you coming. I hope you had a good trading week. I hope you're having a nice weekend, and like I said, I really appreciate you coming to my weekend review podcast today, and I hope it's going to be helpful for you. So, the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to look at all the trades that I made last week and all the current positions that I have. We are going to talk about when I entered the trade, why I entered the trade, what was the setup, what were the confluences of signals that had me take the trade, how I'm going to position size based upon the volatility of the market, how I'm going to place my emergency stop, how I'm going to place my end of bar stop, how I'm going to go into trailing stop mode, how I'm going to sell partial parts of my position into strength, and ultimately how I am going to exit the position. So it was a very interesting week. Boy, it's one of those weeks that's, quite volatile, obviously. And it was one of those weeks where I had some of the best trades I've ever had and some of the worst trades I ever had, all in the same week, which is crazy. But I'm going to show you all these. But again, why I entered the trade, or when I entered the trade, why I entered the trade, and how I am going to manage the trade going forward. And what you're going to see, what I hope to kind of make a case for today is, all we can do is wait for the correct setup, get in, but it's very important that you be very impatient with your losers and very patient with your winners. And that's what you're going to see. You're going to see the positions that are working for me that I'm in for a long time, and the positions that don't work for me, I'm literally out in a day. So remember this. Be very patient with your winners, be very impatient with your losers, and get yourself a process that shows you what to do, right? But patient with the winners, impatient with the losers. I say it over and over, but really it is important. So we're going to go through, take a look at all the positions, everything I've done, everything I got into, everything I got out of, and why. All right. After that, we are going to spend a few minutes and talk about trader psychology. It is the most important skill in trading, the ability to create a plan and then, more importantly, follow the plan. We have a lot of emotions that happen when we have these big volatile weeks, and you need a roadmap. You need a roadmap to tell you what to do. It's a lot better than just going on instinct and what you feel like at the moment. All right. So, but again, you want to get someplace, you have to have a map. You have to follow the map. The map doesn't do you any good if you don't follow it. So I always like to teach trading psychology, and I'm hopeful that it's going to be helpful for you as well. After that, I have gone down through my master watch list. I do that every Friday night. I go down through my master watch list one by one, and I look for potential setups for this upcoming week. Now, these are not where they need to be, but they're within striking distance. They're getting close. And what I'm waiting for is I am waiting for confluences of signals to get into a trade, looking for confluence of, if I'm long, looking for confluences of support. And those would include order blocks, those would include RSI levels, those would include double bottom MACD divergences, major moving averages, halfway points of bars, either up or down trend lines. All right. And so I've identified some good potentials for next week that if they get there, I will definitely consider taking the trade. But you have to be patient. Everything with trading is being patient and being able to find those areas and then wait for that market to come into those areas. And then more importantly, reject those areas. You want to see the market react or reject these certain levels of support and resistance. So anyway, that's what I have on tap for you today. If you do find anything helpful today during this podcast, all I ask is if you could please hit the thumbs up button. It really helps the channel out. It lets YouTube know that there's some valuable content here. And I think, these are things that I know for a fact that there are a lot of traders I think would benefit if they would look at these signals, look at how I manage trades. So I just think it's helpful. I've had a lot of students reach out to me, and just a lot of other traders just say, man, using what you teach really helps. So by hitting the thumbs up button, it really does get it out to more people. So thanks in advance for that. So let's go ahead, run this US legal disclaimer. Let's get that out of the way, and then we'll get rolling. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started. Let's go through the current positions that I still have. This is Coca-Cola. I'm going to break down Coca-Cola a little bit more in detail than all the other ones, just to kind of give you a baseline of how I'm doing things. So this first one I'll spend a little extra time on, and the others will go through a lot faster. I did get Coca-Cola. I entered Coca-Cola here on January 7th, if you can believe this. Actually got the bottom day, and look at this trade. It's just unbelievable. Be nice if all trades worked out this way, but let's first of all talk about why I entered this. So I did enter here at 67.53. Why? Well, you can see we have this green block here. This is called an order block. This is a crucial part of my trading. That I incorporate a lot of order blocks into my trading, and these are, for me, they're considered smart money areas. So let's go back to where this order block formed, and I will explain to you what it is, and how it forms. So an order block, the way that I trade order blocks, people trade order blocks in a lot of different ways. Some very complicated. I try to just make it as simple as possible for me and also my students that I teach. But this is how I look at order blocks. Okay, first of all, I need a swing low. A swing low is a low that has a higher low to the left and a higher low to the right. You can see this is the case. This has a higher low to the left and a higher low to the right. So this makes this a swing low. After the first swing low, I need a swing high. A swing high is the opposite. It has a lower high to the left and a lower high to the right. Pretty obvious, right? So swing low, swing high. Okay, so I need that to begin with. I need a swing low, then I need a swing high. Now, after that first swing high, I need another swing low. This is a swing low. Higher low to the left, higher low to the right. That's lower than the first swing low. So let's do this. Swing low, swing high, lower swing low. Make sense? After these three are in place, I need to focus on this first swing high. Swing low, swing high, lower swing low, and then I need to focus on that swing high. Now, after that lower swing low is in place, if the price goes up above that swing high, that first swing high, this means that the market structure has changed from a bearish market structure to a bullish market structure. So this day is when the market structure changed. And again, why? Because it took out it went above that first swing high. Swing low, swing high, lower swing low, market structure change. As soon as we have the market structure change, the way that I identify the order blocks is I take the lowest closing bar prior to the market structure change, right? Swing low, swing high, lower swing low, market structure change. Now, this lowest closing bar, the high and the low of this bar, is the highlighted green, and I bring it into the future. Now, look here. up here. In hindsight, when you look at these prices, can you go back to where when the order block formed, can you go back and look at this and go, smart money was buying down here? Well, clearly the answer is yes, right? At the moment, it seemed like dumb money, but it turned out to be smart money. So that's why I'm identifying this order block and moving it forward. Now, after the fact, I knew this was smart money. So if the price comes back to the smart money area, it doesn't mean it's going to be, just because it was smart money here doesn't mean it's going to be smart money in the future, but it's more likely to be smart money for the future. So I look after swing low, swing high, lower swing low, market structure change, and I define the order block and bring it forward. I look for potential entry points if and when it gets back into this order block. Okay, so let's move forward to when I entered the trade. So let's kind of get a big picture here. Swing low, swing high, lower swing low, market structure change. I waited and waited and waited for it to come back into the smart money. Okay, so you might ask yourself, all right, it came back into the smart money on this day, a couple of days before you buy it. Why didn't you buy it there? Why didn't you buy it the next day? Well, I have certain triggers, certain rules that tell me to get into a trade. So on the day that the reason I entered on this day was I'm combining I'm combining order blocks with my deep dip buy strategy. And one of the deep dip buy strategies is if you go under the 30 RSI during the day and then you close back above the 30 RSI, that is an entry signal. And that is exactly what happened and why I bought on January 7th at 67.53. On this particular day, we went under the 30 RSI during the day, closed back above the 30 RSI. By the end of the day, that was my signal. So let me see if I can make this a little easier for you guys to see. So that was my signal, 67.53. Now, when I got that signal and bought, I have to decide how many shares to buy, right? So I have a very simple formula that I'll share with you right now of how I position size. And it takes into account two things. It takes into account how much do I have in my trading account? And number two, what is the volatility of the market? When volatility is high, I want to buy fewer shares. When the volatility is low, I can buy more shares. And all that I need to look at is whatever the value of the 2 ATR is on the day that I enter it. Right now it's 203. Back here it was higher, right? But let's just use this number here. So whatever the 2 ATR is on the particular day is what I use. So let's just say I have $200,000, okay, in my trading account. All I do is take 1% of that, which is $2,000, and I divide it by the value of whatever the 2 ATR is on that particular day. And just this has the effect of telling me the correct amount of shares to buy based upon the volatility of that day. So 1% of my total trading account, let's say it's 200 grand, 1% is 2,000 divided by 203 tells me to buy 985 shares. Okay, fine. So I go ahead, I have the signal, I have the under 30, over 30, I have the deep dip buy signal inside the order block, so a combination of strategies, and I go ahead and buy at 67.53, 985 shares. If you have $1 million, 1% is 10,000. If you have 100,000, 1% is 1,000. Doesn't matter. Just 1% of the trading account divided by the value of the 2 ATR tells me how many shares to buy. Okay, so I go ahead and buy my 985 shares here at 67.53. Now, the first thing I need to do is set my emergency stop. And my emergency stop is exactly what the 2 ATR reading was when I did the math. So when I buy here at 67.53, I subtract whatever that 2 ATR value was from my entry price, and I put a red line here. This is my emergency stop. Now, if I have 985 shares and they move down $2.03. How much have I lost? I've lost $2,000. I've lost 1% of my account. Now, it's not fun to lose 1% of your account. It's never fun at all, but that's kind of the worst case scenario, right? I know that I did the math, and if it moves down 2 ATRs, which it should not do, and if it does, then I'm really wrong. I have to have that uncle point. I have to know, okay, I said I was going to lose 1% of my account. I lost 1% of my account. That's it. You are just done with the trade. If after you enter and you subtract the 2 ATR from your entry price, it goes to your emergency stop, I'm out. Anytime during the day, if it hits that emergency stop, I'm out. It doesn't matter if it's 1 minute after the market closes or 1 minute, after the market opens or 1 minute before the market closes, I'm out, or anywhere in between. I hit my emergency stop, that's it. But the good news is that these emergency stops only happen about 5% of the time. The other 95% of the time, if I have a losing trade, it's going to be less than 1%. Okay, and sometimes much less than 1%. So on my emergency stop is generally the opposite of why I took the trade. If I took the trade because we went under 30 and then closed over 30, my end of bar stop would simply be a close back below 30, right? This closed at like 31. So the next day, if it closes at 29.99, just go ahead and get out. Is it going to be a 1% loss? No, that's my maximum loss. It could be a tenth of a percent loss or 0.2% loss. But the point is 95% of the time, your end of bar stop is always going to be, always just by design, it's going to be much closer than your emergency stop. Okay, so I have the order block. I have this entry signal of under 30 over 30. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop, as we discussed on this particular entry, was just to close back under the 30 RSI. Now, the very next thing that I do is I look for the value of the 1.5 ATR, which right at the moment is 152. And as soon as I enter, I take my entry price plus the value of whatever that 1.5 is, and I place it above my entry. This is my trailing stop level. So in other words, if I take the trade, if it gets to my trailing stop level or my trailing stop threshold, it doesn't mean that I do anything. It just means that now I'm in trailing stop mode, which means that in the future, if I have a close below a previous bar's low, I'm going to sell half. So, generally in trading, a good concept in trading is if you take a trade and it moves up, you want to tighten your stops up. You want to move everything up because you don't want to have a nice trade and then give it all back. And there's different ways to do this. But the way that I found that's most effective is that if after I enter it moves to 1.5 ATRs, doesn't mean I do anything. It just means that now I'm in trailing stop mode. And then if I have a close below previous bar's low, I'm going to sell half. Doing that just by default moves all your stops up by half. It dramatically tightens up your stops without having to move your lines around or anything like that. Right? You keep your lines static where they are, but by selling half, it has that effect of tightening everything up. Okay, so everything I've talked about so far, as far as taking action, I've talked about the emergency stop, I've talked about the end of bar stop, I've talked about going into trailing stop mode and then selling half if you have a close below a previous bar's low. These are all defensive moves. So in other words, if the market moves against me, I have to take some action defensively. But I also like to play offense in my trading, just like any good sports team. You have to play offense and you have to play defense. So how do I play offense? I play offense by selling a certain amount of shares, percentage of shares every day, if it moves in the direction that I want it to. Okay. It's one of the best things that I ever designed years ago when I developed this. It makes a huge there's so many advantages to doing this. But first, let me show you how we're going to do this. So I am still in Coca-Cola. And so let me show you how I'm going to do this for Monday, because I do this every day. I have to change the numbers every day. All that I do is I take the closing price of the day. Friday's closing price was $79.03. And then I have the value of the 0.45 ATR. Right now, the value of the 0.45 ATR is 55 cents. So I simply take the closing price plus 55, whatever that is, plus 55. My first profit target for Monday is 79.58. So let's put it up here, 79.64, 79.58. That is my first profit target for the day. Now, I always place 3 profit targets for the upcoming day. So my first profit target is 79.58. To find my second profit target, I just take my first profit target and again add the value of the 0.45 to it plus 0.55. My second profit target for Monday is $80.13. And then I do it one more time. I take the second profit target, $80.13, again, plus the 0.45 ATR value, plus 0.55, 80.68. These are all going to be equidistant from each other. All right, so there we go. Those are my 3 profit targets for the day. And I have to, again, I rework these every single day. If it's lower on Monday, then I rework them. They're going to be lower than here. If it's higher for the next day, they're going to be higher. So the question is, how much do I sell at these levels? I know what my 3 profit targets are for Monday. How much do I sell? It's very simple. Extremely simple. I try to make trading as simple as possible. I take 10% of however many shares I'm going into the day with, and I sell 10% at 3 profit targets. So if I was going into the day with 100 shares, I'd sell 10 at 79.58, I'd sell 10 at 80.13, and I'd sell 10 at 80.68. If I go into the day with 500 shares, obviously 50, 50, 50, just 10% of however many shares. Now, the advantage of this are there's multiple advantages. The first advantage is every time you sell a little into strength, you're taking advantage of the strength of the market. But you are also, every single time you even take off 10%, it has the effect of tightening up your stops even further, even further, even further, because you're selling more and more shares. The other advantage is because you have fewer shares, there's less stress, there's less emotions, and it helps you follow your process even better. It's much easier to follow your process when you just have a handful of shares compared to 5,000 shares, right? So I'm a big fan of taking partial profits, and it just makes sense. In any game, you have to play offense and defense. Imagine if you're playing chess and you're only playing defense. Yeah, well, you need that offensive part. But imagine if you're playing chess only offensively and not worrying about the defense. It's the same thing in trading, everybody. You have to do both. Okay, so I've kind of given you the basics of how I'm setting this trade up and why I took the trade. So let's just look at the trade and follow the, oops, what happened? What did I do? Oh, here we go. All right, so let's just look at the trade and again, just go through it from day one. All right, so I entered the trade here, 7th of January, 2026 at 67.53. Why? Deep dip buy signal of intraday rejection of the 30 RSI inside a bullish order block. I position size. I place my emergency stop 2 ATRs below. My end of bar stop is the opposite of why I got into the trade. I got into the trade because it went under 30 over 30. So next day, if it closed back under 30, I would get out. Luckily, it didn't do that. I placed my 1.5 ATR trailing stop level above, and the very next day, here we go. Boom. Great day. Sold multiple profit targets into that strength. I also got into trailing stop mode. Next day, up again. profit target. Next day, kind of nothing. Next day, up, a profit target. Next day, up, not enough for a profit target. Remember, I'm in trailing stop mode now. And then on this day, on the 15th here, we had our first close below a previous bar's low after reaching trailing stop level. What did I do? I took off half of the shares, the remaining shares that I had. I took off half because we had a close below previous bar's low. I locked in a gain of 4.14% on those shares. One of the best things in trading you can do is take off half, take off 50%. Because if you take off 50% and it goes down, you're really glad you took off 50%. If you take off 50% and it keeps going up, you are glad that you have 50% left. And that's exactly what happened here. So took off half here for a gain of 4.14%. Just kept going up, right? Profit targets here, profit targets here, profit targets here, profit targets here. Didn't quite get a profit target on Friday. Got close, but didn't quite get there. So at this point, right, I've talked about the stops and the emergency stops, but there's a certain point where I'm going to exit this trade to the upside, and we are getting very close, right? We are at 81.90 RSI level. Usually when you get to 70 RSI, that's usually it for at least for the short term, but this one has just gone parabolic. So this at this point is very easy for me. If I get to a 65 RSI level and get a close below this 5 EMA, I'm completely out of the trade. Well, certainly we're above 65 because we're at 81.90. So this trade is very, very easy at this point. If I get a close below the 5 EMA, that will be the end of the trade. If it continues to keep going up, I will just continue to sell partial profits into that strength. Now, looks like here from the charts, we have earnings on the 10th of February. So I never hold through earnings. So basically this trade is done. I will exit this trade on Monday regardless. And it's been a great trade. And the remaining shares that I have at the moment are up 14.6%. But big picture on this trade, as with any trade, let's kind of look at it big picture. I waited for the price to come into a significant support area, smart money area, order block area, and then I looked for a signal to actually trigger me into the trade. My end of bar stop was minuscule. I mean, it could have gone down a 0.25% the next day and it would have gotten me out. So getting into trades that have support, that give you a very good risk to reward ratio, where you're getting out very quickly if you're wrong, and you have a process to keep you in if you're right. And this is a perfect example of that. So great trade on Coke. Remaining shares I have up 14.6%. I will exit before earnings. All right, let's go to the next trade, T-Mobile. Okay, so T-Mobile, this is a combination of different strategies. I entered T-Mobile here on the 28th of January at 186.20. Okay, so I entered 186.20. I placed my emergency stop, as always, 2 ATRs below. So why did I enter the trade? So this one's a little unorthodox. I mean, not unorthodox, it's just that it doesn't happen very often. But there's two reasons why I looked at this trade. The first reason, let me show you the trend line. A megaphone trend line is when you have a swing low and you have a lower swing low and you connect those swing lows and that trend line goes out into space. And after you've made two touches, here's a swing low, here's a swing low, once you connect those, now I'm keying off of this trend line, okay? And I'm looking for a rejection of that trend line. Well, you can see the previous day here on the 27th, it closed below the trend line. And then on this day that I entered the trade, it closed back above that trend line. So that was a trend line reaction. In addition to that, we had what is called an abandoned baby. An abandoned baby is where it consists of 3 bars. Bar 1 or bar 2 gaps down from bar 1. You can see here we gap down. So it was bearish overnight. We gap down. But bar 3 gapped up. And when you have a gap down followed by an immediate gap up, when you have a very quick change in sentiment from bullish to bearish, that kind of foretells higher prices. Okay, so what I did on this particular day is would I have just taken the close under, close back over the trend line or rejection of that megaphone trend line? Probably not. I like to look for confluences. But in this particular case, I did have a confluence. I had an abandoned baby, the gap down followed by the gap up, crazy abandoned baby, bullish abandoned baby, in addition to the rejection of the trend line. And so that was a confluence of signals. That's it. That's why I got in the trade. So I got in the trade here, 186.20, position size, placed my emergency stop 2 ATRs below. My end of bar stop would simply have been a close below this trend line. I placed my trailing stop level 1.5 ATRs above, as always. Next day, takes off, profit targets. Perfect. Next day, boom, big move up, multiple profit targets into that strength. And I also got to trailing stop level. I passed the threshold. I don't do anything, but I am in trailing stop mode, which means if I have a close below previous bar's low, I'm going to get out of half. The next day down a little, but didn't close below the previous bar's low. The next day opened below the previous bar's low, but closed back above, kept me in the trade and a profit target. The next day up, profit targets. And then here you can see on Friday, we had our first close below the previous bar's low. After reaching trailing stop level, what did I do? I took off half of the remaining shares that I had going into the day, or at the end of the day, for a gain of 5.75%, but only half. If this goes down, I'm going to be glad I sold half. If it goes up, I'm going to be glad that I still have half. So been a nice trade, interesting confluence of signals, but again, the confluence was a rejection of a megaphone trend line, in addition to a bullish bullish abandoned baby. And it worked out nicely to the tune of 5.75% so far. McDonald's been a monster. I got into McDonald's here on the 21st of January at $305.20. All right, let's take a little closer look at it. Why did I get into this trade? My favorite setup is a deep dip buy entry along with a order block. Now, order blocks, there's different ways to get into these. You could get in with the rejection of the high of the order block. You can get into it with the rejection of the low of the order block. You can get into it with the rejection of a moving average or another key point inside the order block. So on this particular trade, the reason I got in were twofold. The first is we rejected the high of the order block, right? The day before it closed in the order block, and the day that I entered, it closed above the order block. So that's a rejection of the high of the order block. In addition to that, it had a deep dip buy signal. The deep dip buy signal was a close under and then back over the black line, which is the 200-day moving average. So I entered 305.20. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is simply going to be a close below the black line, a close below the 200-day moving average. Is it a good risk to reward ratio? Well, I have my 2 ATR emergency stop for sure, but look, that 200-day moving average is much closer to my entry price. So the next day, had it closed even 1 penny below that 200, I simply would have gotten out. I know my maximum allowed loss is going to be 1%. So if it had closed down here, maybe I'd lost 1/4%, maybe 0.5%, maybe 1/3%, but not quite 1%, right? So it's going to be lower than your emergency stop because the emergency stop's the worst of the worst, right? So I place my 1.5 ATR trailing stop level above. The next day it goes up a little bit. I think I hit a profit target on that day. The next day definitely went up enough for a profit target, selling into some of that strength. The next day, I hit multiple profit targets and I got into trailing stop mode, and then up and up and up and profit targets. And remember, I'm in trailing stop mode, but I just haven't had a close below a previous bar's low. And then a profit target here and a profit target here. And then on this day, I took off half of my position. Why? It didn't close below a previous bar's low, but what it did is it rejected the 70 RSI. During the day, it went above the 70 RSI and then closed below the 70 RSI. Okay, that is one of my exit rules. About 90% of prices, when they get up to the 70 RSI, they stop going up, go sideways, or go down. So if I reject a key level like that, that's telling me that I need to do something. And I did. I took off half the remaining shares for a gain of 5.68%, but I still have half. The next day, up again. And then the next day up again, and then more profit targets here on Friday. Okay. Now, I exited the entire trade on Friday. Why? Because earnings are Monday morning, at least for that's what my charts say. So earnings are Monday morning. So I exited the entire trade here on Friday, right here at the close. On the second half, 6.71%. Right. So you see right here, it says earnings 2/9/26. That's Monday. So I'm not going to hold to earnings. So I exited the entire trade, and it was nice. So half, I locked in a gain of 5.68%. The remaining shares, I locked in a gain of 6.71%. But again, it started with the confluence of the rejection of the high of the order block and the deep dip buy signal of the close under, close over the 200. Just a great trade. Just a fantastic trade. Thanks, McDonald's. Berkshire Hathaway, another great trade. I entered Berkshire Hathaway here on the 29th of January at 475.68. Why? Combination, multiple combinations. I told you last week that there were 5 signals on this particular entry. It's hard to get 5 signals. So let's break them down. What were they? Well, the first is we rejected the bottom of the order block. The second is we had another deep dip buy RSI signal. It went under the 30, closed back over the 30. So the rejection of the bottom of the order block is a primary signal. The deep dip buy rejection of the 30 RSI is also a primary signal. We also had the megaphone trend line that we rejected by closing back above it. That is another primary signal. That's 3 primary signals. I'm not surprised the market bounced there. Okay, but I said I had 5. Well, the other 2 are not primary signals, but they are secondary signals. And that would be, we had a V2, right? A V2 consists of 3 bars, bar 1, 2, 3. 2 goes under bar 1's low, 3 closes above bar 1's close. It's not a signal I'm just going to get into a trade with just by itself, but it helps the trade. It's a secondary signal, V2. And then also we rejected the negative third ATR channel. 92% of prices tend to stop going down or reverse back up when they get to this level. And so this all happened on this day. That's why I entered 475.68. So I position size. I place my emergency stop 2 ATRs below. My end of bar stop is just simply a pick, take your pick. It could have been a close below the 30 RSI. It could have been a close below the bottom of the order block, the trend line. If one happened, they were all going to happen. Okay. So then I place my 1.5 trailing stop level above. Next day we go up. profit targets. Next day we go up again, multiple profit targets, and I get to trailing stop mode. Next day up again, multiple profit targets. Next day up again, multiple profit targets, selling into that strength. Thursday, nothing. Friday, I did hit one profit target. Now, where do I go from here? Well, if it continues up, I will continue to take partial profits. You can see we're at a 65.18 RSI. So if it goes up to the 70 RSI and rejects that, I'll sell half of what I have. But you remember that I said if you get to a 65 RSI level and then close below the 5 EMA, that's an exit point for me for the entire trade. Well, that's where we're at. Look, we're at 65.18. See the thin blue line here? That's the 5 EMA. So in the future, if we close below that 5 EMA, that's my signal to completely exit the trade. But this has been a really, really good signal. Remaining shares I have of 6.32%. VIX. Okay, old VIX. Boy, this has been something of a trade. Really, really. I hit more profit targets on this trade than I ever have in all my 30 plus years of trading. So let's break down where I entered. I entered here at 26.29. Why? It's an order block. What makes it an order block? You have a swing low, you have a swing high, you have a lower swing low, and then you break market structure to the upside. As soon as you break market structure to the upside, it defines the order block. This is the lowest closing bar. So I highlight the high and the low of the order block, and I bring the order block into the future. Now, as soon as we broke market structure, we had a pullback. Yes, we did. Notice this solid green line in here. I told you before on order blocks, a rejection of the high, rejection of the low, rejection of a major moving average inside the order block, or a specific point that I put in. I put this point in myself, this green line at 26.10. I put it in based upon this bar. This is a big up bar. You see this bar? Well, if you have a big up bar, halfway of that big bar is going to be a key Fibonacci 50% level. There's going to be support there. Not all the time, but more times than not. And remember, I'm always looking for key levels within key levels. So the first key level is the halfway of this big up bar. The second key level is this order block. So I entered here on the 15th of January at 26.29 because we had the previous day created the bullish order block, and then we came back into the bullish order block. Okay, we came back into the smart money area. But in addition to that, we rejected this halfway line that I put. That's why I entered 26.29. Okay, so I position size. I placed my emergency stop 2 ATRs below. On this particular trade, my stop was just a close below the low of the order block. The next day, it took off like a freaking rocket ship. I literally hit 8 profit targets. Not the very next day. Sorry. The next day it went up a little bit. But the day after that, rocket ship up. I hit 8 profit targets. I took 80% of this trade off into that strength. Normally, honestly, I would have just taken the trade off, but because for the podcast, I wanted to show you the process I was following. So that's why I kept it, right? And so the next day it came down and I took off half of the remaining shares. Why? Because we had our first close below a previous bar's low after each trailing stop level. Okay, locked in a gain of 1.6%. But the previous day, I had gains into the double digits into that strength, right? And then we came back down, and I said in the podcast, I said, look, we're back in the bullish order block for VIX. If this is bullish for VIX, this is bearish for the market. Well, that's exactly what happened. As soon as we got back to the bullish area, which meant the market rallied and VIX went down, I said, very likely now that we're back into this order block, the market could likely go down. Well, VIX went screaming back up. And as you know, the market went down, right? So I took half, I sold half with the close under that previous bar's low, and we stayed in the order block. And as it moved up here into strength, I sold into strength, and then it pulled back. And as soon as it came back here, I was like, yeah, I think very likely the market will go down. And that's what happened. We had 3 huge days down in the market. And like, I hardly have any shares left, but I sold, I followed the process into the strength up and so forth. So the remaining shares that I have on VIX up 4.82%. Now, if the market continues, the stock market continues to go up, VIX will very likely come back down into this order block. However, if VIX comes back down into this bullish order block, it would lead me to believe that very likely the market will head down again. Okay, so watch VIX. It's important. When VIX gets way up here, that means the market's probably going to rally. If VIX comes down into this area, at least for now, that probably means we're at the top. Okay, so the remaining shares left on VIX, and it's been a great trade, up 4.82%. And again, based upon the bullish order block. Apple's been a great trade, and glad I could take this trade because, one of my favorite setups is called a higher low V1 or a higher low V2. But we just haven't had them a lot. I've had some students, people say, "Do you still trade that?" I'm like, "Yeah, I absolutely do," but I haven't had them. Well, I finally had this trade on Apple here on the 30th of January. I entered at 259.20. Why? Well, let me bring your attention to these 2 green lines, this top green line and this bottom green line. This is the 1 ATR, this is the negative 1 ATR. This is what I consider to be called the value zone. Okay, when you're under the value zone, things are undervalued. When you're above the value zone, things are overvalued, right? I want to buy ideally undervalue and sell in value, or I want to buy at value and sell above value. So the rules for this particular setup is first we need to have some closes below the negative 1 ATR channel. Well, these all clearly closed below it, okay? So we need to close below the value zone. Secondly, we need to close back in the value zone, which happened here. And then after we have that close, we need a pullback. And then we need a pullback followed by a V1 or a V2. Well, this is a V1. A V1 consists of 2 bars, bar 1, bar 2. Bar 2 has to go under bar 1's low. Bar 3 has to close above bar 1's close. That creates a V1. That's what got me into the trade. So again, close below the order block, close in the order block, pull back, followed by a V1. And I have a video on my YouTube channel, V1s, V2s. It's a really good video, goes into details about V1s, V2s, a lot more than I'm doing now. So check that out. I think you'll find it helpful. So I entered here 259.20, position size correctly, placed my emergency stop 2 ATRs as always. Now on a V1 or a V2, your stop is a close below halfway of the washout bar. Bar 2 is the washout bar because it washes out or goes below bar 1's low. So again, I entered here 259.20 and you can see this red line here. This is my stop. If the next day it had closed below halfway of that bar, I simply would have gotten out. But it did not, thankfully, because higher low V1s, V2s are strong. Now, as soon as I entered, I placed my 1.5 ATR trailing stop level, 1.5 ATRs above, and off we go. Next day, takes off like a rocket ship. I sold multiple profit targets into that strength, and I'm also in trailing stop mode. Sorry, let me look at something here. Yeah. Okay. Now I'm in trailing stop mode. The next day, nothing. Next day goes up big. Again, I hit multiple profit targets into that strength. And then here on the 6th, I exited half. Why? Because on this day, we went above the 70 RSI during the day and closed below the 70 RSI. That's my rule to take half. So I locked in half for a gain of 6.08%. Pretty nice, right? pretty nice. And then but I still have half now. And on Friday, we were up again and I hit another profit target into that strength. So I sold half for a gain of 6.08%. And the remaining shares that I have up 6.78%. So going forward now, if it continues to go up, I'll just take partial profits into the strength. I already had we already have the rejection of the 70 RSI, so that's off the table. So now going forward, if I have a close below any previous low, I'm out of the trade. Or if I close below the 5 EMA, I'm out of the trade. So this trade is really on autopilot. It's very easy. Either we close below the 5 EMA, I'm out, or any close below a previous bar's low gets me out from here going forward. If it continues to go up, I'll just continue to sell into the strength, and then eventually we'll get a close below previous bar's low, and that will be it. So I locked in half for a gain of 6.08%, and the remaining shares that I have on Apple up 6.78. PLTR, Palantir. All right. I did enter Palantir here on the 5th of January at 129.62. That was Thursday. Why? Rejection of the bottom of this order block. That was about it. One of my students and friends, Vivek, he said, Greg, why did you get into PLTR? There really weren't any confluences. And he was right. He really was right. There's some large volume down here. Large volume bars tend to mark bottoms, but really the only reason on this particular trade, it's a little out of character for me, but was the rejection of the bottom of this order block. And the risk to reward was clearly really good, right? We had 3 strong days down. It did test under the order block and close back above. So I did enter 129.62. I position size, I placed my emergency stop 2 ATRs below, placed my 1.5 ATR trailing stop level above. And then on Friday, you can see obviously we had a rally, and I did hit a couple profit targets into that. We are not to trailing stop level yet, but one thing we do have here is we have a bullish abandon baby. Wednesday we gapped down, Friday we gapped up, making Thursday's bar a bullish abandon baby. So yep, so took that trade, this particular trade up pretty good for one day, up 4.44% looks like. So going forward, if it continues to move up, I'll continue to take profits into that, hopefully get to trailing stop level. If Monday we close back below the low of this order block, I'll simply have to get out of the trade. But good trade, really good start to the day, 4.44%. Okay, so those are all the open trades that I have. And I showed you what the process was going to be, where my stops are, what I'm going to do. But as long as these keep moving my way or stay above my stops, I'm just going to stay in the market. So these were 1, 2, 3, 4, 5, 7 monster trades, obviously, right? Let's go to the trades that didn't do so well, right? Because there's always going to be some losers. And certainly I had these this week. That's what I was telling you. On some of these trades, some of the best trades for a long time, and then some of the worst trades for a long time as well. So let's start with XYZ. Okay, so this is XYZ. This is block. So I did enter block here on the 2nd of February at $60.33. Why? Well, 2 reasons. We had a rejection of the high of the order block, meaning that during the day we came into the order block, but we rejected it by closing above. That is the primary signal. Secondary signal, we rejected the negative 3rd ATR channel, not primary, but secondary, but enough for the confluence. So I entered here $60.33. I placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop level above, and the next day, boom, closed below the low of the order block. That was my stop. So what did I do? I immediately got out of the trade because I was just flat wrong and lost 1% on the trade. But again, the previous trades that I showed you that were working, I stayed in them. This one, in one day, out the next day. Am I glad that I got out? Yeah, I am, because it just went down and down. Of course, it was up on Friday, but that's just how it goes. I waited for the signal. I had a confluence of signal. I position sized correctly. I knew where my emergency stop was, which was close below the low of the order block, and it happened. That's all I can do is get out of the trade. So there you go. Once you place your trade, you have no control, but you have to know exactly what your plan was. And my plan was, if it goes up, take profits, get to trailing stop mode, so forth and so on. If it closes below the low of the order block, get out of the trade. And that's exactly what I did for a loss of 6.16%. TLT, also a losing trade. I bought TLT here on 12/26/25. These are bonds at $87.73. Why did I buy this here? Well, this bar here on the 23rd was an abandoned baby. The previous day we gapped down. The very next day we immediately gapped up. Okay, when you have that quick movement in bearish sentiment to bullish sentiment, more times than not, when you look in the future, the price is going to be higher. Well, this time it didn't work. So when I bought here, 87.73, this is the one type of trade where I don't take partial profits, don't go into trailing stop mode, anything, because these are such strong trades. About 70% of the time, they go in the direction that I want it to. So this particular trade, I placed a 2 ATR stop loss below my entry, and I placed a 4 ATR profit target above my entry. In my experience, about 70% of the time, I will hit the 4 ATR profit target instead of the 2 ATR stop loss. So what am I really looking at? I'm looking at a 1% loss if I hit my stop loss. I'm looking at a 2% gain if I hit my profit target. Like I said, 70% of the time, I tend to hit my 4 ATR profits target, and 30% of the time I'm hit my stop loss. And that's it. I take the trade, I set the 2 ATR stop loss, the 4 ATR profit target, and I just let it go. And eventually one of those two are going to hit. Well, this was one of the 30% of the time where here I hit my stop loss, and I did lose 1.48% on the trade. And I got out right at the bottom. But what do you do, right? That is what happens. But would I take this trade again? 100% of the time I would, because I know about 70% of the time I'm going to be profitable. 30% of the time I'm going to have a loss. And this was one of the 30% where I did have a loss. I did have to respect my loss. And like I said, I got out for a loss of 1.48%. Last is ARK. Not a great trade, but last week was kind of tough. I got into ARK here on the 4th of February at 69.94. Why? Nice confluence of signals. We rejected the 250-day moving average and the top of the order block. Really good confluence, really good trade. Like I said, I got in 69.94. I placed my emergency stop 2 ATRs below, and what happened the very next day? Boom, hit my 2 ATR stop loss. Okay, loss of total account loss 1%, percentage wise on the trade 5.34%. So again, not all trades work, but hopefully you're seeing a pattern here of when I'm right, I stay in the trade. I'm being patient with the winners. When I'm wrong, I'm very impatient. I showed you two trades where I got in one day and out the next day. And I got out at the low and it rallied right back up, but that's just how it goes. But all in all, this week was a nice, profitable week, even with hitting two emergency stops. I told you they only happen about 5% of the time, but over the last couple of weeks, I've hit more emergency stops than I have since last March. But of course, the market's been volatile. So we've got 1, 2, 3, 4, 5, 7 current trades that are doing really well, and 3 that didn't do well that I got out of, and we'll see what happens next week. Okay, so in addition to trading daily bars, I also trade weekly bars. Now, weekly bars, you're going to make your decision on a Friday because weekly bars close on Friday. And I did enter IGV, which is the software ETF, and I entered that on Friday at 82.46, exactly where it is. Why? Well, we have an order block on the weekly bars. That's the green box, right? All this means is that in the past, this was smart money before it rallied, and now we've come back to the smart money area. See, look at the swing low, swing high, lower swing low, market structure change. And after that market structure change, it went up very, very high. And so when you're up here and you're looking back here, did smart money buy here? Yeah, clearly it did. 100% it did. So I mark the smart money area. And if we come back to the smart money area, is it going to be smart money again? I don't know. We're going to see, but more likely than not. Now, it did reject the bottom of the order block, meaning during the week it went below the order block, closed back in it. That's a primary signal. In addition to that, we also rejected the 200-week moving average and the 250-week moving average. So there is the confluence. So again, I entered on Friday on the weekly bars, 82.46. I placed my emergency stop 2 ATRs below, and my end of bar stop is simply going to be a close below the low of the 200-week moving average. So I don't know if I'm going to be right on this trade, but I know exactly what I'm going to do. It rejected 2 key levels, or in other words, the price came down here, the market tested it, ran out of sellers down there, said, no, we don't want to go any lower, and closed back above. That was the signal for me to take the trade. Now, next week could be a whole nother thing, and it could close below. But very likely, if I'm wrong, I'll be wrong fairly small. But if I'm right, I have the potential for some nice upside. So again, I just got into this trade, so it's exactly even. And let's go to the last current trade that I have open, which is UUP, also on the weekly bars. I've been in this trade for a long time, so that probably means I'm in the money, right? That's correct. You're not going to see me in a trade where I have a losing trade that I'm in a long time. Those get taken care of quickly. So I got into UUP, the dollar, back here on the 11th of July at 26.31. Why? Well, here we have an order block, and you can see inside the order block we have a 200-week moving average. On the week that I bought it, it rejected the order block because the previous bar it was in it and then closed above it, so that's a rejection of the higher the order block. That's a primary signal. In addition to that, we had a deep dip buy, close over the black line, which is the 200-day moving average. So I entered 26.31. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop on this particular trade is simply a close below the 200-week moving average, the black line. I placed my 1.5 ATR trailing stop level above, and let's see what happens with the trade. The next week it went up. Profit targets, great. Started off good. Next week down. Next week up big. Multiple profit targets into that strength. I also got to trailing stop mode, so now I'm in trailing stop mode. Next week down. Next week down. First close below a previous bar's low. After reaching trailing stop level, what do? I take off half the shares, took off half the shares for a gain of 0.49%. And then we essentially moved sideways for a month. This was a pivotal bar here because during the week we were way below it. Remember, a close below that 200 is my stop. But by the end of the week, it recovered, kept me in the trade, okay? Thankfully, because the next week was up, sold into that strength. Next week, nothing. Next week, up big, sold into that strength. Couple sideways weeks. Next week, up, again, sold into that strength. Down this week here, sold into that strength here. Then when we go down for about a month and a half, then we have a rally up, profit target, and then we've come back down. This bar 2 weeks ago was interesting because my trailing stop level on this particular trade now is a close below this 200-week moving average. Again, we went way below it, but closed back above it, kept me in the trade. And then this week was up where I sold another profit target into that strength. So the remaining shares that I have on the dollar up 2.59%. So there you go, everybody. Those are all the trades, winning, losing, and daily and weekly. So I got rid of XYZ, TLT, ARKK, took my losses on those, but getting rid of the losers and keeping the ones that are working. All right. So before we take a look at the potential trades for next week, let's talk a little bit about trader psychology. We'll spend just a few minutes on this. All right, this week's trading psychology code is from the Tony Stark Facebook page. It's a great page, really, or Tawny, sorry, Tawny Stark. But for years, he has been putting out really good information. So if you're on Facebook, look up Tawny Stark and subscribe because every day he posts really great, informative things about trading. So in this particular post, this is from Linda Rashke. And I've met Linda before. I went to one of her trading workshops years and years ago. Uh, what a great trader. She was featured in Market Wizards, and many people say she is the probably the most famous female trader that there is. So when she posts something, let's take a listen. She knows what she's talking about, and I remember I learned a lot in her workshop. So let's see what Linda has to say. The most difficult task in speculation is not prediction, but self-control. Successful trading is difficult and frustrating. Yes, it is. You are the most important element in the equation for success. So let's just kind of break this down. The most difficult task in speculation is not prediction, but self-control. So many people try to predict. I know many traders. Greg, what do you think next week's going to do? What do you think earnings are going to be? How do you think the market's going to react to this or that? And I always say, like annoyingly, I'm like, I don't know. How would I know? I don't know. I don't have a crystal ball. I don't have inside information. And why? I always go off on rant. Why are you trying to predict this? You don't know either, right? But so many people try to predict. They play earnings. It's it's a rocky road, everybody, to try to predict. You don't have to predict. And most people's prediction ability is horrible. Instead of predicting, why not just wait and let the markets tell you what it likes or doesn't like, or if it rejects a certain level? When I am looking for rejections of order blocks, rejections of major moving averages, rejections of RSIs, these the market is telling me exactly. I don't have to predict. It's telling me it's rejecting a level. It's saying we don't like it. There are no more sellers under here. We don't like it. Then it's more likely to go up. It's very simple, but people try to predict. I'm just telling you now, quit trying to predict. The charts are going to tell you everything you need to know when they reject key levels. So the most difficult task in speculation is not prediction, but self-control. It's all about self-control, everybody. Trading is not that hard. It's super hard, but it doesn't have to be that hard. It has to do with you and your self-control following your process, right? Whether you learn a process from me or someone else doesn't matter. But learn a process and stop predicting and follow it. Follow the process, but that takes self-control. Successful trading is difficult and frustrating, 100%. You are the most important element in the equation for success. Or in other words, you following your process has more to do with whether you're going to make money or lose money. I know I harp on this every single week, everybody, and I guess I have to apologize, but really I'm not apologizing because I know so many traders around the world that fall into these traps and they don't do very well. I'm telling you, they don't do very well. The traders that do well are the traders that follow your process. So get yourself a process and follow it. Like really. People ask me, Greg, who would be your ideal student? Would it be somebody, that graduated from like Harvard or Yale? I was like, oh my God, no. It'd be the worst. People that go to Harvard or Yale have pretty high IQs. The higher your IQ, the worse trader you're going to be. I promise you, because if you're smart, you have a high IQ, you're going to try to predict stuff. I said, give me an 18-year-old kid that just got out of Marine boot camp. That's who I want, because they know how to follow orders. They know how to follow a process. So if you're cursed with a high IQ, I'm sorry. It's good for other parts of life, but for trading, it's really bad. Humble yourself, quit predicting, and just follow your dang process, everybody. Really. So thank you, Linda Rashke. I appreciate that. I hope this was helpful and sunk in a little. Quit trying to be smart and just follow your process. And thanks, Tony Stark, for this really good trade. All right. All right, so as I mentioned last night, every Friday night I go down through my master watch list and I try to identify some potential candidates for next week that are getting kind of close to some good confluences of signals. And this week I have 8 of these. Now, I mention this every week because it's important. Here are 8 potential trades for next week. Theoretically, it's possible that any day next week, all 8 of these could trigger. Does that mean I would take all 8 positions? Absolutely not. I only take 1 trade per day. Even if I have 8 really good candidates or entry signals on 8 different markets, I'm still going to narrow it down to the best one. And how do I do that? Well, I give a score to each particular legitimate entry. If it has 1 entry signal, just to make it simplistic, if it has 1 entry signal, I give it a score of 1. If the second one has 2 entry signals, I give it a score of 2, and so forth and so on. But I also have to look at the risk to reward. Maybe I have something that has, remember on Berkshire Hathaway, 5 signals? The only reason I took it was because it had 5 signals, but it also had a good risk to reward ratio. A lot of times if you have 5 signals, it's going to have run way away from the stop, and the risk to reward's not going to be good anymore. And so I'm going to have to pass on that signal. So I look at multiple signals, give it a score, then I have to overlay the risk to reward on that and make a decision on that. That's going to change the equation. I like to look at higher time frames. I'll give you an example here on actually, yeah, I'll do that in a minute. I forgot to show you that on the trade that I took on Friday. That's exactly what I did. Was I looked at the higher time frame to give me some information about taking it on the shorter time frame. All right. I also look at the relative strength of a market. Maybe if the market's down, but this particular market's up, okay, it gets an extra bonus point because of the relative strength of that particular market, and vice versa. If the market's up, but this one's down, that's going to factor in the equation. So I look at how many entry signals it has, what the risk to reward is. I look at the higher time frames to see if that can give me some good information. I look at the relative strength, okay, and that's what I do. And that's how I trade. That's what I teach my students. And by the way, if you are interested, I teach students all over the world. I have taught them for many, many years, and I teach a one-on-one course that's a 20-hour one-on-one course. I think the best way to learn anything is to have your student or your mentor, just you and him or you and her, right? So that you can ask as many questions. And I have turned out some really great traders over the years. Like I really have. And I would love to have you as a student. I have taught people from absolute beginner level up to advanced hedge fund traders as well, and everywhere in between. So, if you would like to learn the art of and the skill of trading, I will teach you. I will teach you every single strategy that I use, all the rules. We do a lot of simulation trading in the course, and it's 20 hours. It's 2 hours a week for 10 weeks. It's great because we can see how the market changes together and so forth. And right now I have some really, really good students, Bruce and Jake and Nacho, and they've all been doing really, really well. But I'd love to have you, student. All you have to do is send me an email. The email's in the link in the description. We usually kind of have a get to know you call. It's not a sales call, I promise you. I just want to learn more about you, your trading, your goals, your challenges. And it's a good time for you to ask me any questions about the format and the course. All right. And so I'd love to have you as a student reach out to me, and I'll teach you everything that I know. In addition, you've heard me talk about deep dip buy, and of course I teach that in the one-on-one course, but I also have a really good online video course available at udemy.com. It's a 9.5-hour course that teaches you exactly how to trade the deep dip buy system. It's very affordable. It's between $30 and $50, and I think I have like 4.85 out of 5 stars on that, and sold again so many around the world. And if you're interested in that, the link's in the description as well. So anyway, there's my plug, and let's get on to the potential trades for next week. All right, so AMD. Now, this is exactly what I was just talking about as far as having a legitimate signal but not having a good risk to reward ratio. Okay, so Friday, AMD did reject the bottom of the order block. You can see Thursday it was below the order block and then it closed above the order block. Is it legitimate? Yeah, it is. Did I take it? No, I did not. Why? Because the risk to reward ratio is not that good. Now you can see, look, I took AMD over here. I still have it marked up. I took AMD over here when I had a good risk to reward ratio. It rejected the high of the order block and it rejected the 100-day moving average. And I wrote it up all the way and sold it here, where my rules told me to get out. Was it right? Thankfully it was. But now we are back down here. So what do I do with this? Really nothing. But so we had a big day up on Friday, but if we do come back, I have this midpoint here at $200.10, the green line. If we do have a bit of a sell-off after Friday's rally and we come back and we test this $200.10 level and reject it, so we pull back to it, we bounce at it, or we go under and close back above, now I'm more interested in taking the trade, because then I would use that $210 level as my line in the sand or my end of bar stop. So if it came back down to it, tested it, closed above, I would certainly consider it, because remember, levels within levels. This midpoint is a level. This $200.10 is a key level inside an order block, which is a key level. So that is what I'm looking for. Now, I guess it's a good time to mention this. So you've heard me talk about having big up bars and having support at halfway. Well, look, on Wednesday, we had a big down bar. Now, if you have a big, big, big down bar and you rally, you're going to find some resistance at about halfway of the big down bar. And we closed a little bit above it. So, but very likely we're going to be stuck here for a while. I mean, it's possible we could just race up, I guess. Unlikely, but possible. But this Wednesday bar tells you a lot. Big down bar. Okay, we got oversold, we rallied, but we got right to about half. So another reason I didn't want to take the trade on Friday, one, I don't have a good risk to reward ratio, and two, we're stuck dab in the middle of this big down bar. So just to simplify things, everybody, what I'm looking for is I'm looking for a rejection of this $210 mark. I would then use that $210 mark as my stop. Or if we do come down even more substantially and reject the bottom of the order block there at about 194.15, that would also be another potential entry point with a good risk to reward ratio. But when you have big down bars like this and then you have big up bar rallies, I don't like to chase those, because we have a lot of overhead support or resistance above us here. It just feels heavy. It just feels heavy. So before I take a shot at anything like this, I want to pull back. And if it doesn't pull back, then fine. I just don't get it. But if it does pull back, rejection to 210 would be one, or the rejection to the bottom of that order block there, like, well, let's get an exact price. The order block starts all the way, way back here. 194.28. So that's what I'm looking for in AMD. ARK. Okay, ARK's the same thing. It did reject the bottom of the order block and the top of the order block as well. But look at Wednesday's bar. Big down bar. We literally stopped at about halfway. So this one's a little bit simpler. We have this 300-day moving average running inside this order block, and the 300-day moving average is at 68.36. If we were to pull back, reject that 300-day moving average, which now is 68.36, bounce, intraday reject, or close back under, close back over, I would be much more likely to take that. But again, could I have taken this trade? Yeah, I could have. This middle bar is a abandoned baby, gap down followed by a gap up. That's bullish, but big move up off of a big down move. Wednesday's down bar, halfway of that. Yeah, I just don't trust it. I just don't trust it. But I want to pull back, rejection of the 300-day moving average 68.36, then I would consider it. Boeing, all right, I talk a lot about bullish order blocks, but there is such a thing as bearish order blocks as well. And here in this red area, we have a bearish order block. What makes a bearish order block? It's the opposite of what makes a bullish order block. Here we have a swing high, followed by a swing low, followed by a higher swing high, and then we break market structure to the downside. Now look, when price was down here, and you look back at the bearish order block, would you consider that smart money or dumb money? Well, at the moment, clearly it was dumb money. People that would buy up here, they got hammered. So if we come back up into this kind of dumb money area, I know it sounds bad to say dumb, uneducated money, I guess, then more likely than not, when you get back up here, it will be uneducated money again. So I am looking for a short. Now, look at this big down bar here. Big down bars, if you rally to halfway, that's probably where you're going to have resistance. That very likely, if we continue up, that's about where it will stop. Doesn't mean I'm going to take a short there. But as far as a short, what I would be looking for would be a rejection of the bottom of this order block or the top of this order block. The low of that order block is at 249.02. The high of that order block is at 253.77. So rejection of the bottom of this order block or the rejection of the high of the order block, I would consider to get short. Now, having a bearish V1 or a bearish V2 inside of this bearish order block would also be a potential entry for me as well. So that's what I'm looking for. I'm looking for, we change market structure to the downside. When you change market structure to the downside and you check back up, that's generally the best place to short. And so that's what I am looking for. Google. Okay, well, talking about changing market structure, here we go. Swing high, swing low, higher swing high. Clearly, market structure change. When you change market structure to the downside, I want to look to short rallies. Really, what I'm looking for two areas to potentially short. The first one, an ideal one, would be here at 343. One, it's inside a bearish order block, and two, that 343 level is exactly halfway of this big down bar. Remember, anytime you have big down bars and you retrace back to halfway, you're going to have inherent resistance there. And that inherent resistance of the big down bar lives inside the bearish order block. So that is one potential area, 343. The second potential area for me to short would be here at 336.80. Why? It's halfway up this big down bar. Now, Monday, if we rejected this 336.80 and closed back below, could I take the trade? Sure. Place my emergency stop 2 ATRs above. Where's my end of bar stop? Just to close back over 336.80. If it rallies higher and rejects this halfway down bar at 333, could I take that short? 100%. Where would my stop be? A close back over the 343 level. Okay. Now, one thing I want to point out to you, talking trend lines, look at, we have this swing low, we have this higher swing low here. You connect these dots, this is your trend line. As long as you stay above this trend line, that's the support. Well, Thursday, clearly we broke the trend line. Well, that trend line's still there, but now that trend line is resistance above us. And you can see on Thursday, when we broke it, where did we stop? Right, almost, it went up above it a little bit, but where did it close? Exactly at the resistance of that trend line. And so this trend line now above us is resistance. Now, we had the big reversal bar on Thursday. If you have a big up bar, where are you going to find some inherent support? Halfway. Look on Friday. Where did it stop going down? Halfway of the big up bar. So my guess is that, or just from a technical standpoint, very likely you'll stay above this line and below this line. So technically speaking, you're probably going to range in this particular area. But as far as entries goes, I'm looking for a potential short with the rejection of 336 and the 336.80, and that would be my line in the sand, or a rejection of 343 for the short, and that would also be my line in the sand. And what I mean by that is if it rejects 343 and the next day it closes at 343.01, I'm out of the trade. Intel. Well, you see red. What does that mean? That means it's a bearish order block. Swing high, swing low, higher swing high. Market structure change. The market structure defines the bearish order block. This one's a narrow order block, so I'm looking for a potential short with the rejection of the low of the order block, which is 53.08, or the high of the order block, which is 54.60. It's a pretty, it's not a very tall order block, so the risk to reward's pretty decent. Pretty decent. So I would be looking for a short somewhere with the rejection of the bottom or the top of that order block, and the bottom of the order block is 53.08, the top is 54.60. Meta. All right. Previously had a really, really good trade on Meta back here on 121. Why? Rejection of the high of the bullish order block, rejection of the trend line, bullish baby, and you can see that was a great trade. I got out here, I got in here, got out here before earnings, and then we had earnings, and then it's just been downhill from there. Okay, so this is a bit of an interesting potential trade. So you hear me talk a lot about abandoned babies. In addition to abandoned babies, we have something called an island reversal. An island reversal is the same as an abandoned baby. It's just that abandoned baby uses one bar, island reversals use two or more bars. Well, this day formed an island reversal. Why? Because on this day, on the 16th, we gapped down, and then more than one bar, we had two bars, and then this day gapped up, leaving, see these two bars kind of leaving it in the dust. Well, the high of that, this is called the island reversal. When it's one bar, it's an abandoned baby. When it's two or more bars, it's an island reversal. So the high of the island reversal is going to be the support at 618. There's just going to be some inherent support there. Well, if I bring that into the future, that level, do you see how that's starting to dovetail with this trend line that is now ascending? So essentially, really what I'm looking for at this point is going to be a rejection of this trend line, the first trend line that I took the trade off of. But that trend line If and when it gets there, it may just go up. But if it does continue down, that 618 level will be probably a good key level to potentially get in off that level. And that 618 level is just right in the same neighborhood as that trend line. So the 618 level should give some support, and that upward sloping trend lines should give some support as well. So just make it simple. Really, I'm looking for a rejection of 618 this coming week. And I use that as my line in the sand. If it rejects 618, I consider take the trade. If it closes below 618, out. Silver. Boy, I've had a lot of emails about silver. This is massive destruction. Really massive destruction. And the change in structure is very simple. Swing high, swing low, higher swing high. I guess if anything broke structure to the downside, it would be this one. But now we are extremely low. Now there is a bullish order block. The bullish order block starts here on 12/31/25. Again, when you look up here, when it was at $110 and you look back down here, was smart money buying there? Well, yeah, clearly they were. If we come back to that smart money area, is it smart money again? I don't know. But I do know from 30 years of experience is that more times than not, it is. Well, look where we stopped going down, everybody, in that bullish order block. Now, I didn't take this trade on on Thursday, because it didn't reject the bullish order block. It got into the order block, but it didn't quite close above it. Had it closed above, very likely I would have taken that trade. And then you can see on Friday it was up 5.25%. So you might ask, Greg, why didn't you take that trade on Friday? Because Friday it did reject the high of the order block, and you're right. But again, it comes back down to risk to reward. Now the risk to reward's not great because my stop would be a close below the low of this order block here at 63.43. So essentially what I'm looking for is a pullback on silver where it maybe just rejects the high of the order block, giving me a better risk to reward ratio, or rejects the low of the order block. And let me get those numbers for you exactly. So that order block, the high of that order block is 66.88. The low is 63.53. Ideally, a rejection of the bottom of that order block would be better. It's a lower price and maybe a better risk to reward ratio. But this is a good example of, yes, I did have it did reject the high of the order block, but again, I have to factor in and overlay the risk to reward and go, okay, well, it's already up 5.25%. And what would be my percentage-wise, what would be my stop? Well, if it's to the bottom of the order block, it's like almost 10%. That's not a very close risk to reward, right? So a rejection of the high of the order block, I would consider the high is 66.88, the low is 63.53. So I would prefer a rejection of the low of the order block, but a rejection of the high of the order block, I certainly would consider it depending on how high above it closes. Tesla. Same thing with Tesla as with AMD and ARK. Okay, I didn't buy this on Thursday. I could have, because it rejected a key level that I put in 393 inside the bullish order block. I bought Palantir instead. But could I have bought Tesla on Friday? Yeah, I could have. It rejected this megaphone trend line. It rejected the high of the order block. But again, the risk to reward ratio is just not that great. And again, look, we're at about halfway of Wednesday's down bar. Doesn't surprise me that we stopped there. So going forward, coming back down and rejecting this 393 level would make a lot more sense, because then that's my level. If it rejects 393, if it goes under 393 and closes at 394, yeah, I would take that trade with my stop being back at 393. But we are very far extended above there at the moment. So I'm going to wait for a bit of a pullback back to 390, rejection of 393 at the very least to potentially get into the trade. I did want to show you, I was trying to make that point about looking at multiple time frames. And if we go to IGV, okay, I bought that on the weekly bars on Friday, right? Why? Rejection of the bottom of the order block and rejection of the 200-week moving average. But when I talk about looking at higher time frames, this is a perfect example. So this is a weekly time frame. If I'm looking at the weekly time frame, I need a higher order or a higher time frame. I go to the monthly. Well, look what happened on the monthly. On the monthly, we rejected the 50-month moving average. In addition to on the weekly, the time frame that I took the order block or took the trade on was a rejection of the 200-week moving average. So that makes sense. When I saw this, I was like, oh, this is a good trade. Rejected the bottom of the order block, rejected the 200-week moving average. Let me look at a higher time frame and see if there's anything there. At the same time, it rejected the 50-month moving average as well. So I didn't want to leave today without making that point. So listen, everybody, I hope you found this helpful today. If you did, I would appreciate it if you could hit the thumbs up button. If you could subscribe to the channel, I would really appreciate that. But listen, if I can help you with anything with your trading, like I said, I teach the courses, I do consulting. I can help you in a lot of different ways. So just contact me. Love to have you as a client. Love to have you as a student. I hope you have a really good rest of your weekend. Please be careful next week. Yes, we've had this rally, but there's still a lot of overhead resistance levels in a lot of things. So one day, a new trend change does not make. So please remember that. I always like to leave off with, if you could please try to go out and do one nice thing for another human being each day. If you have the opportunity, just good vibes, man. You know what I mean? It helps the other person. It's also good for you. It's a win-win all around. If you have the opportunity to, do a nice little act of kindness for an animal, that would be great. They appreciate acts of kindness just like we do. I think if we were all trying to strive to do one nice thing for another human being or an animal each day, it really would make the world a better place. So I appreciate you being here. I hope you have a nice rest of your weekend. If you have any comments or questions, please put them in the comments section. I'll do my best to get back to you. But please be careful, be good, and God willing, I will see you next week. Thanks a lot, everybody. Take care of yourself. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.